our framework for evaluating both plans, portfolios, as well as individual positions is LIVE, and it has 4 key components that we want to make sure to address: liquidity, income, volatility, and expected return. And the key really, again, is finding a balance between all 4 of those things for each person's unique story. Running money, managing wealth, again, not a theoretical exercise, but a practical one. Too often times people look at something like expected returns and say, well, we should have just invested in this, it would have done the best. But you got to take into account that markets, life, have a lot of unexpected twists and turns. You're going to need liquidity at certain times. You're going to need income generation at various points in your life cycle. We all can only put up with so much volatility. And again, we all need to have some type of a return on our investments to help us build wealth. So with that, we'll take a look a little bit deeper at each one of these 4 components. Liquidity, real simply, how quickly can you get your hands on that money? If you think about something like cash or US Treasuries on one end of the continuum, extremely liquid, you can get access to them really at any point in time. On the other hand, you might have something like a physical piece of real estate or a private equity investment or even a certain small cap stock, something that's less liquid, less thinly traded. You may be able to get your hands on it, but take a cut as a consequence, or you simply may not be able to sell it. There may not be a buyer at the time you need to sell that you can get out. Second piece is income. And again, we touched on this last week. The reason income generation is so vital is if your investments are generating an income level commensurate with what you need, then you're not going to be able to force to sell to supplement that. And so you then are empowered to sell when you want to, as opposed to when you might need to. And that's, again, an important thing to keep in mind. It's often a cousin of liquidity. If you're generating enough income again, maybe then you can take and have a little less liquidity somewhere else in your portfolio because you're not going to need to sell any or all of that portfolio because of the income generation. So again, these things not only are trade-offs, but they also work in tandem with one another if you can find the right balance. The third component is volatility. And volatility really has 2 different aspects to it. One is psychological. All of us really have a certain emotional point at which we crack, and whether that's just stress of life. I have a good friend who was a SERE instructor for a number of years, and he would talk about, hey, look, everybody has their breaking point, right? And one of the things he would work with soldiers with is helping them understand that might be a little bit more than they think, but again, not pressing them to that breaking point. Same thing with investments. We've covered this before, that your brain and how it responds to mortal dangers and trauma is actually the same way it responds to losing money. And so really making sure, again, we take that into account of really what is that point, because we never want to go past that at a point where then you would sell again at an inopportune time. The second piece is financial. The reality is there's volatility not just to markets, but to life, to needs. Unexpected things come up. That could be something difficult like getting laid off or having an unexpected bill or expense rise. It could be something really positive like a trip you want to take or a new dream that you want to be able to pursue, or your child getting into their dream school, but that dream school costs a little bit more than you might have expected. So making sure that we have, again, a plan built for all the unexpected twists and turns that can come our way. Finally is expected return. This is obviously the most common one that people think about and want to maximize. And we've talked previously about how, look, you can beat the S&P 500, at least historically looking, by investing in small cap value stocks. But the problem with that within this continuum is they can not necessarily be as liquid as one might need. They don't produce a whole lot of income. They're extremely volatile. And so again, taken in totality, is that something that's really going to work with your overall plan? It might work for a piece of it, but having that myopic focus of simply trying to maximize return might not work for any of those previous 3 reasons. In summary, what we hope this framework can do is inform your decisions. How are you building your plan? Is it taking into account these 4 different aspects? Does your portfolio then reflect all of these? And of course, can even be used to evaluate a singular position. You might have a great return, but are you taking too much risk to get that return? Are you giving up too much liquidity? Is it giving you the income you need? All of these things need to be considered when one's looking at their financial plan in any of its aspects. Too often, again, without this framework, you see people who maybe they overemphasize liquidity or volatility reduction, and therefore they have a bunch of cash sitting in the bank account, not generating the income that they may need, not generating the expected return they may need. On the other hand, people who get way too overweighted into real estate or private equity or more speculative investments, seeking that maximum return, maybe seeking great income generation, but not realizing that they've given up a great deal of liquidity, or they've perhaps invested in things that are going to have a volatility associated with them that's far more than they can have. To listen to the news media and to listen to the punditry, perhaps it's your neighbor who's fascinated with this. It's all about making a call when it comes to investing. And sadly, these people, that thought that predominates so much of market talk these days, really loses sight of what are the roots of investing. And as simple as it sounds, it's so critical. And it's this, that at the end of the day, when you're investing in a stock, you're really investing in a company with the hope of sharing in either presently or in the future, their future profits. If you're lending that company money in the form of a bond, you of course want to get paid an interest payment. And I say this is lost because of two reasons. Number one is the importance of income, of cash flow, whether that's coming to you in the form of a dividend payout or a bond payment. It's a huge part of investing. For stocks, the majority of the S&P 500's return historically has come through dividend payments. Of course, bond payments, the return you hope to get for the most part is whatever that interest rate that's tied to that particular fixed income instrument, none of which has anything to do with market timing. And in fact, when you really dig into that power of income, so much of the pressures of trying to time markets or make the great call, you realize not only is it not productive, it's counterproductive. So we're going to look at a few things today, areas where investors might be able to find yield, and then dig a little bit deeper in terms of how the power of income reflects that and some other things to keep in mind. So where can clients find income in a world of pretty low interest rates? With respect to equities, global equities present a tremendous opportunity. Janice Henderson put out a great piece that will be cited below, where they looked at how are global dividends doing. And as of Q1 of this year, as we're just wrapping up not too long ago, dividends are already up 10% year over year to just under 1.4 trillion for the year. They're on pace for the total calendar year to grow by about 8.5%. And so this again is one great area lost by a lot of people who get really fixated on individual securities or maybe even an individual sector of the market that they could be missing out on, that has proven over time to again be a huge component of total return itself, but also a very resilient way to get income and return through volatile markets. Dividends, unlike those share prices, don't have the same measure of volatility. And just because a share value is dropping doesn't mean the dividends connected to that stock may drop at all, which is again something that surprises a lot of people. Some other areas where we think investors should be spending a little bit more time looking are high yield bonds, are bank loans, some parts of the global bond market. You can still get in many cases over a 5% income stream, and historically high yield bonds, those bank loans, have given equity-like return with a lot less risk. And there's a great piece that we'll cite from AllianceBernstein that talks about just that phenomenon. Here's the other part about the power of income with respect to bonds. Two great charts that I love to cite with clients and others. One was put out by Bain Capital, where they looked at this power of income and really looked at an investor within the context, of an investor who could have timed the market perfectly, gotten in when valuations were cheap, gotten out when they got expensive. And what they found was even if you did that, even if you were able to buy and sell at those correct times, the income you would have lost by being out of the bond market over the last 27 years would have created such a drag that you actually would have underperformed that bondholder that stayed invested the entire time. So again, as I alluded to earlier, not only would timing of the market not helped you, it actually would have been counterproductive. American Century put out a great piece a few years ago that looked at it from a slightly different angle, but brought the same point. As we talked about last week, so many investors are afraid of interest rates going up. And while it's true that it can create an initial drop in value, that ability to reinvest at higher interest rates actually can be very accretive, positive for an account value. They looked at a study where you had a 5% rise in rates from about a 3% yield level. And while it did create an initial drop of about 20%, you were back to even within 3.5 years, which is a lot quicker than your typical stock market drop. But more importantly, over a 10-year time frame, you would have had about a 30% greater gain than had interest rates not moved up. So tough in the short term, absolutely. But in the long term, again, actually a more beneficial thing for investors. How do you pull all this together? How do you find those great global equities? How do you find those managers that can help you navigate these bond markets? Because again, I get it. We don't want for our clients to see those 20% type drops alluded to within the American Century approach. And that's where active management can become so critical. If we look at some of the bond managers we work with who are very adept at shrinking their energy exposure a few years ago, they didn't get hit on their high yield bond exposure the same way as people who were just buying an indice or just indiscriminately trying to buy things based off the highest interest rate and yield. A lot of thought went into that. And again, research would show you, certainly we found that active management with respect to that bond component or that global equity component can be very beneficial and typically tends to outperform many of their passive counterparts. Remember the importance of income, remember the roots of investing, and take heart with the fact that with that well-constructed portfolio, not only can you hopefully retire earlier by getting more income, but have a safer retirement as well by the power that income and yield can bring to a portfolio. Thanks so much.